Gold and silver surged to a record high, fueled by inflation and Eurozone sovereign debt woes. Gold is hovering around peak levels, exceeding the $1,400 per ounce mark. Silver is also maintaining its gains, having risen to a 30-year peak. Analysts say the demand for precious metals could continue to climb amid low interest rates, the European sovereign debt crisis, and jitters over the global economic slowdown. And for more on the prices for precious metals, we're now joined by Manoj Ladwa, senior trader at ETX Capital from London. Hello, and thank you for joining the program. Now, Manoj, is there a clear link between this latest surge that we've seen in the gold price and last week's decision by the US to print up to $1 trillion in new money?
I think there is a very good link, Karina, between what the US Federal Reserve did last week in pumping more money into the US economy and the way gold is behaving at the moment. What they've served to do is put more money in the economy. This has served to depress the price of bonds, depressing the price of the dollar as well, and this acts as a natural catalyst to push the price of gold higher. And so what we've seen in the last few days is the price of gold pushing through that $1,400 level and pushing onwards and upwards for the foreseeable future. It's difficult to see where this rally would end. A lot of market commentators are saying that there's bubble-like conditions within gold. Well, if they're bubble-like conditions, we're not seeing the volatility that you typically expect in a bubble, like in the tech bubble of the late 90s, early 2000s, the housing bubble of a couple of years ago.
Now, speaking of this price target, I mean, is there any of a price hike? Is there what's the price target for the gold rally? And do you think that basically the gold price is driven by traders themselves?
Well, it's difficult to put a price target at the moment. I see the round figures as obvious levels for gold to head to. So $1,500, now that it's broken through $1,400, would be the next level up from there. Above that, you've possibly got $2,000, which is a massive increase in the underlying price of gold. But you're seeing more and more traders buying futures contracts, and I think most importantly, buying ETFs, exchange-traded funds, and that's serving to push the price of gold higher. Now, it's questionable whether these contracts will be deliverable into the underlying, whether there's enough of the underlying asset there to be able to be delivered if the futures contracts were taken to expiry. So it's a difficult situation for gold, and it could come screaming back down if it does choose to sell off.
Now, over the past decade, we've seen many governments selling their holdings of gold. Who owns most of the gold nowadays, you think?
Well, funnily enough, the US government still owns the vast majority of the world's gold. It's obviously held at Fort Knox, and they've been steadily increasing their stake. The UK, as it has been well documented, sold a large reserve of its gold a good few years ago, down near the lows, but we still own a significant chunk. But then after the US, you've got Germany, you've got the IMF that still hold a very large stake. People would think that China would hold a significant amount. It comes to around about number 7 in the world, and it's mainly the US and the European countries that dominate the top 5.
And do governments actually own enough gold to, say, return to the gold standard?
I think it depends on which governments. There's certainly the US government, and if they colluded with the likes of the IMF and the European governments, then yes, I believe we could return back to the gold standard, but that would be under extreme conditions.
Well, thank you very much for joining us in the program. That was Manoj Ladwa, senior trader at ETX Capital, talking on gold prices. Thanks very much.